It's something that we added, I think, last week or the week before, where if you guys don't know what the VIX is, it's the Volatility Index. If you guys aren't trading using the VIX, where are you, right? This is probably one of the most useful things to look at when you're trading. So this is the VIX index, otherwise called the Volatility Index. Basically what it does is it measures what's called the implied volatility on the stock market, right? And it's looking at a bunch of expirations on stock options, and it's saying, based on those expirations, what is the implied volatility? It's, but it kind of just boils down to like, what is the implied volatility on those options? It's using the Black-Scholes model, essentially, to figure out, based on the price of the option, what are people thinking is going to happen to the stock market? So the reason why the VIX index works is because whenever people are expecting the stock market to go down, and these are usually sophisticated traders that are trading in options, the options traders tend to be, a little bit more highly educated than the rest of the market. Let's put it that way, because it is a more complex thing to be trading. And so whenever they're expecting the stock market to go down, they tend to buy put options, right? So if you're buying put options to expect that the market's going to go down, it's kind of like you're buying insurance, right? So if I'm a trader, let's say I'm on Wall Street and I'm trading the S&P 500, and I think things might go bad, right? Everything might go to hell, right? Then what I would do is I would buy put options on the S&P 500 so that if the stock market goes down, I make money. So it's almost like a form of insurance. And that's what the VIX index measures here, is how much are people willing to pay for that insurance. So whenever people think that the stock market is going to fall, you see big spikes. So here, for example, 2008, really big spike, right? October 24th, 2008, the VIX index was at 79. It was huge, right? Right now it's at 17. We're quite calm right now. That was the whole tariff thing, right? So you can see here very clearly every single time that people started to panic about the market. And then it wasn't until COVID that things kind of got really crazy and stayed pretty high for a while. And not until, it wasn't until December of 2023 that things calmed down. So it's a very good gauge of like how crazy people think the market's reacting to things right now, right? Okay. So we're using the VIX and we're saying, okay, as long as it's below 21, then we're going to trade. If it's above 21, stay out, right? So basically, if it's 2008 again, just don't trade, just stay away from it, right? Which I think is a very good thing to be doing. Again, not financial advice, but I wouldn't want to trade options when it's like 21, especially not call options, especially not betting on the way up. If the VIX is at anything above 21, I'm out. I'm going to go to the beach for a bit. Go relax for a little while.
Okay, like what you saw? See the strategies we've created in the marketplace, or create your own with our powerful trading AI at www.botspot.trade.